Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
Welcome everybody to episode 3 of Turtle Talk. It's Friday, the 30th of May, 2025. I'm Rich Brennan, here with my fellow Aussie turtle, Adam Havriliv, and as always, we're joined by the legend himself, Jerry Parker. And today, we've got a treat. It's rare to get all of the classic trend followers together for a brainstorm, but this month, that's exactly what we have. So joining us is someone who's become a standout voice in the modern trend following space. Co-founder of the Twoquants, founder and CEO of Takahē Capital, advocate of classic trend, and now launching a bold new program with Takahē Capital, the one and only Moritz Seibert. So in this episode, we'll explore why Moritz made the leap to pure trend, how he's designing for edge in his latest program, and we'll touch on index performance, manager standouts, market chop, and do some trend following myth busting along the way. But before we dive in, let's check in with everyone. Adam, how's it going down in beautiful Sydney?
Well, getting a little bit colder, not European cold, but cold enough for me. So
wallabies and jackets.
Yeah, absolutely. So, and a little bit colder on the water, but we will survive. We will survive. How about yourself, Rich?
Yeah, it's pretty chilly up here in sunny old Queensland. So I've got I'm starting to rug up a bit. But when we talk about cold up here in Queensland, I think people in the Northern Hemisphere in the US and Europe, they might think we're a pack of whingers over here talking about the cold here. But anyway, Jerry, how's things on your beautiful side? You're in Florida at the moment?
I am. I'm in Florida. It's really nice here. It's around 7 a.m. and it's already 81 degrees. So typical, almost June weather for Florida. Everything's looking really nice. But Floridians love their air conditioning. So when you go out to the grocery store or the restaurants, you have to wear multiple layers because it can get pretty cold in there, even when it's hot outside. So I got my multiple layers on this morning.
Hey, Moritz, what's the weather like over there in Germany?
The weather is beautiful today, but it was miserable the last couple of days. We usually have a wet April, but this year April was very nice and dry, and May was kind of like wet and cold, but it's changing now. So it's beautiful outside. I'll be playing some tennis later on. It's about 25 degrees centigrade, whatever that is in Fahrenheit, probably 85 to 90 Fahrenheit, something like that. Blue skies, you can see the Alps. It's good.
Well, back to trend following. So let's kick it off with Battle of the Trend Following Indexes, where we look at how classic trend and the other trend followers performed during April. A pretty wild month for most, I suspect. Classic Trend Index did have a bit of a pullback during the month. But I think that was a broad industry event with pullbacks in all of the major indices that we look at. And I think the numbers for us were down 7% for the month of April, and that compared with down 6%, 6.5% for the TTU index, SG CTA and SG Trend down around about 4.5%, 5%, and the systematic momentum CTA index also down 4.5%. So that's bringing us into some pretty red numbers for year to date and for the quarter. Rich, what are your observations?
Yeah, so definitely it was a tough month, April, and we're finding it certainly hasn't picked up too much this month. It's still fairly tough from our end. But look, what I do notice is that the classic trend index, unlike the other indexes, it came off a high watermark this year in 2025 and about earlier this year. But the other indexes, they're basically heading deeper into drawdown over the last 12 months or so. So I suppose there is a bit of a difference there between the classic trend index and the other indexes. There's a bit of a divergence that was happening, but certainly classic trend, because it's got this lifting power, it necessarily incorporates a bit of higher volatility there. So when we get the drawdowns, we do get fairly good drawdowns, and we're certainly in one right now. But we'll probably discuss this during this episode. In that, to obtain these outliers, these significant uplifts in the equity curve, you must be able to entertain drawdowns. It sort of comes with the package. Because even though people say, oh, these drawdowns are bad for compounding or whatever, they forget about the uplift created through the outliers. And that uplift, without that volatility, without that drawdown, is pretty well impossible. So you must be able to embrace the drawdown to get the uplift. And unfortunately, we're just at a point in time now where we're in a drawdown. That's how I see it.
Yes, absolutely. And I think, Richard, you're right there to compare and contrast year-to-date performance and then also year-on-year or even 2-year-on-year performance. Classic trend still in the black on the 2-year rolling performance, and then down sort of in line or less actually than the peers over the 12-month period, notwithstanding a little bit more volatility this year. So I don't know if it's classic. I don't know whether it's necessarily the volatility of the individual programs. Jerry, do you have any thoughts on performance year to date?
Well, only that there's just no refuge. There's nothing happening that's going to pull us out of this in another sector. We got whipsawed in the stocks. There's no direction in the interest rate markets, and maybe we got really crushed in the currencies, and then they got long most of the currencies, and they stopped going up. So there's just nothing out there really. Just a few trends, maybe in the commodities still looking pretty decent, but there's really nothing generating the profits. And during bad periods, when people write papers about why CTAs are losing money, the conclusion is always the same, and that is they lose money when there's no big trends. So these small losses add up, and that's where we are right now. Treading water and trying to preserve capital.
Thanks, Jerry. And Moritz, any light on the horizon for your program?
Who knows? But what I'd like to say with these drawdowns is, as far as trend programs are concerned, I mean, Rich, you said it's risk and reward. We're trading at a higher level of volatility, so we need to expect deeper drawdowns. Now, you could say about any strategy that it's probably a good thing to buy the drawdown. Like, with the benefit of hindsight, if you buy the S&P 500 in a 50% drawdown and you can keep to that position, you're making new highs, and it looks like that was a good idea. You can say this really about any strategy that made the comeback, right? But in terms of trend, what happens, or what usually happens during these drawdowns, is that we have a portfolio reset. Maybe not entirely, but to a larger extent. We're getting kicked out of existing positions. We're getting kicked out of legacy risk. We've lost long positions in equities. We reversed some of the currency positions. It's just we have a lesser amount of risk on. Now, what that means for us is that we can essentially go back to placing small bets or appropriately sized bets, which in expectation have a small loss and hopefully occasionally a large winning trade. but there's not a lot of open trade equity, not a lot of open trade profits at that point in time that we could possibly give back. So that is something that makes the trend following approach, as you know, so resilient, so much more protective compared to other strategies. And therefore, I would say that buying into these CTA drawdowns, obviously the drawdown could get worse, right? But buying into these CTA drawdowns is usually a good thing to do, especially right now. I think, if anything, we'll be chopped up on small losing trades. We have a gold position. We still have a coffee and a cocoa position where, there's the potential for some more give back. But most of the other positions that we have, if anything, they're going to lose 1R or less than 1R. So it's going to be a sequence of small losses, but no big losses. And that's a good thing to know.
It's different to, say, a buy and hold in the S&P, where when they entertain a drawdown, they don't release risk. They hold on to it, and it just goes deeper and deeper. But at least with our drawdowns, it's sort of like a risk release event where we close out of those high risk trades, and we're ready to reset with small bets and accommodate future risk, as opposed to being concerned about the increase of existing risk.
You said it so much better than I did. Yeah, that's exactly right. And that is a difference, I think, between buying the CTA drawdown and buying the S&P 500 drawdown. Because the S&P 500 drawdown, you just don't have any. There's no stop. There's no switch. There's just nothing. I mean, the thing could go down and down and down.
Yeah, that's right. And then, the maximum drawdown, we can sit here and beat ourselves up all day, but the reality is that our maximum drawdown over the period of analysis, still sub 20%, well under 20%. I think we're reporting there at 14.6 maximum drawdown for classic trend index over the analysis period. And that would compare favorably to the drawdown in the S&P 500 during that period. So I think we sometimes do give ourselves a little bit of a harder analysis than, let's say, passive long-only equity holders would, right? Because we're not sitting here saying that this thing will keep going to 50 or 60%, as the equities have done many, many times. So should we move on to what moved the needle?
All right, Adam, here we go. So welcome to What's Moved the Needle. This is where we dive into the key market moves that left a mark in April. It was a month defined by sharp reversals, sudden momentum shifts, and some surprising outliers. And we've pulled together a few standout charts to help make sense of it all. So, Adam, let's start with you. Which futures market caught your attention and why?
Okay, I've got a couple of charts here. The euro reversed out of a bearish trade that I think most trend followers would have been in earlier in the year. And so that has caused some pain on the unwinding. And then we've hit 12-month highs through the 112 area. And that did push up a little bit higher and then back, but interestingly has held the breakout level and is now sitting above the 112 area. And that looks like, an emerging trend. And I would put that in contrast with gold, which obviously a lot stronger over the analysis period. And so we're in a period of consolidation here, a bit of a pullback, $400 or $500 swings. But for those with sufficiently loose pants, that shouldn't have shaken you out of your positions. So I suspect that Jerry and Moritz are still sitting pretty nice with their gold position. And, that is a textbook long futures trend trade. And then, the S&P 500, which undoubtedly would have caused most managers a little bit of bother over the last 6 months with, the reversal from a long trade, an exit from that long trade, potentially going short. And then unfortunately for those short trades, a pretty strong rally. And then we're almost looking at breaking out again to 12-month all-time highs. And so that's me in those three charts.
Nice one, Adam. They're good charts. Okay, Jerry, you've got some charts as well for the month that you'd like to share with us?
I do. So I have a couple of stocks in the JGBs. So these two stocks are pretty crazy charts. Centrus Energy and IonQ, and sort of just shows in an extreme way kind of what happened over the past few months, where we had a big sell-off in stocks and they sort of started coming back. And this is a good example. Both these stock charts are just really good examples of how important it is to have loose pants and trailing stops not too close to the market, and just to follow these rules. The good thing about allowing markets that have nice profits to turn into really small profits, as these two charts indicate, is that the back test likes this idea. It likes the idea of having long-term breakouts and looking at the chart patterns like this and how much pain and suffering they cause, and just sticking with it and not being too eager to get out of the trade. And
they're beautiful loose pants, Jerry. That's some major retracement here, but you're still in them.
Right. Rob came up with a pretty good line a few weeks ago in his podcast with Niels. He said, "Hey, Niels, are you going to ask me about the size of my pants?" So that was a good one. And so, yes, I am is the answer, obviously all the time. But I think another thing you hear a lot that's kind of a cliche and a myth that needs to be busted is over the years, I've heard traders say, when you have these big profits, or small profits or any kind of profit, don't let it turn into a loss. Get out with a one-tick profit. And this is just really scratching this itch of human beings needing to be rewarded and feel good about booking a profit. Whereas if the computer in the back test kind of says, yeah, don't consider doing that. Just come up with the right entry and exit parameters and just go with the flow. Whatever the trades look like on the chart, even if the trade maybe even looks like it's in a downtrend, but you have your entry and exit rules and parameters, stick with that. And hey, look, if a big profit or a nice profit turns into a loss or a small profit, this is just another example of you being given the opportunity to do the hard thing and do the right thing and do things that's hard for other people to do. I think the JGB is another really great example. Not only do you want to have loose pants on the trailing stock, but you also want to have sort of loose pants on the stop loss, not have that stop loss be so tight. 1 or 2 ATRs is too tight, maybe 10 is too big, but something in between those two where you can still hang in there as long as you can and give these trades as much possibility of turning into trends as no matter how unlikely it looks, because you're not good at guessing what's going to happen in the future. And these at the lows in those two stock charts and at the high in this JGB trade, our mentality was really desperate and really not optimistic about these trades whatsoever, which is okay as long as you just follow the rules. And one way to combat choppy markets like this is to have loose pants and wide parameters.
Yeah. So, Moritz, stepping back from the individual markets, when you look at, say, April's behaviour, what broader trends or market characteristics stood out to you?
So looking back at April specifically, gold was working nicely, which was probably one of the very few positions that was providing cover for most of the other markets which generated losses. The trend program that we're trading took the biggest hit on JGBs, which Jared just showed the chart. That was a quite a spiky move. It coincided with the Swiss franc and some of the currencies reversing pretty much on the same day, causing a loss. We've took losses on equities. We were long most equity markets, not everyone, but most of them we had a long position in. We got kicked out of most now. I think the only ones that we are still long is in South Africa, where we've just got a long entry signal for the topics.
Still in cocoa?
Yes, we are still in cocoa, and but it was probably something like 25 basis points. We were very, very close to losing that long position, like extremely close. By the way, we did lose the long position in London cocoa. That one's gone and it hasn't come back. But ICE US, New York cocoa, we still have that. It was very close to being stopped out, and it didn't look that great, I think, in April. But now in May, we were very lucky to have it. It made a comeback, started trading north of 10 grand again. It's less than 10 grand today, but it seems to be going higher again. We're also still long coffee, which hasn't been working particularly well the last couple of days. But the system tells us that it's not yet time to say goodbye to coffee. So we're holding on to it. Yeah, and then other things. I mean, some of the books or some of the trades that we still have on the book for quite some time is short the grains. We're short wheat. We're short milling wheat. These trends are still intact, and many of the other things just got put into the mixer and whipsawed around. So that is what you've just said. That's been the risk release. So we've just lost a lot of positions. Like when I just do the list of stuff that we have on, it's probably half the length compared to what we had 6 weeks ago.
All right. Well, great discussion, guys. So let's move forward to our next segment. This is called Rising Stars and Trend Titans. And this is where we spotlight some of the standout managers from the April 2025 report, which I prepared through ATS Group. So I'll lead us through that one. So let's dive straight in. So April was a challenging month for trend followers, marked by sharp reversals and a lack of sustained momentum. Despite these headwinds, some managers demonstrated remarkable resilience and adaptability. So in April, understandably, we noted that most of the trend following programs in our report, they sustained fairly heavy downturns, stepped into quite large drawdowns for April. But we noticed in this report that there were quite a few non-trend, what I'd call multi-strat programs, which had a component of trend in them that managed to hold up for April. As we're all aware, from a trend following perspective, we can't look in terms of short term, 1 month, 1 year. We've got to look in terms of the long term. And over that perspective, when looking in terms of the long term, the 5 year, the 10 year, the 20 year or whatever, you realize that these drawdowns are an inevitable part of our process. But what I would like to say is that in comparison, for instance, with the trend following programs against multi-strat programs, we do find multi-strat programs tend to exhibit less volatility overall than trend following, but I tend to say that does come with a cost of lower what I call upside potential when those trends do hit and when we get on our game. But Moritz, have you got anything to add here in relation to that report you might have read from ATS?
I think there's probably only a handful of trend or CTA type managers that made a positive return in April. Some surely did, but most were down, and some of them down significantly. I think the stock trend CTA index has hit its worst ever drawdown. We've seen some of the worst ever drawdowns for CTA funds and trend following managers. That includes some of the brand names, folks that deploy heavily valued risk and vol control and all these types of risk controls to keep them out of trouble. Even these guys have been hitting their worst drawdowns recently. So it's just been a very tough period. I think most of them will also be slightly down in May as it looks, as we're recording this in May, but not as much as in April. April was just, incredibly difficult for trend following managers. So if you escape that, it probably wasn't pure trend. I'm not aware of, short term. Okay. Well, if you're trading very short term trend then you could have had a positive April. But if you're like a medium to long-term trend following, and if that is really what you do without style drift, then showing a positive number for April, that would be very surprising.
One of the questions I'd like to ask perhaps Jerry is that when we're dealing with dynamic position sizing, volatility control, where it's our understanding that what that does is it tampers with the outlier potential. It potentially reduces the uplift associated with outliers through volatility control, dynamic position sizing, etc. So, for instance, in the cocoa example, where we were holding into trend, that they necessarily with increased volatility would be selling into that trend. Now, my concern is this, Jerry, and I just wondered if you have any comments here, is that yes, we have noticed that a lot of these, the larger trend following programs that do express dynamic position sizing, volatility targeting, etc., they have entered these drawdowns. Now, traditionally, this hasn't necessarily compromised the classic trend follower, because the minute there's these significant outliers, we go from these periods of high drawdown and immediately explode into new high watermarks. My concern is that with the dynamic position sizing, volatility control, will they be able to bounce back when the trends return with that same speed that classic trend following can?
I would say, just to answer your question specifically, I would say yes, if we get, they tend to do very well when there's broad sector of movement. So if all the currencies go, and if all the interest rates have a move, or all of the stocks pick up, then they will do pretty well. Where we set ourselves up to profit from maybe an idiosyncratic move as well as the broad sector move. So depends on what kind of move comes up. I think it's interesting that you brought up the cocoa example. Okay, that's one way that they reduce the profits on something like that and smooth it out a bit and take profits, because sometimes the big trends will crash and they get out just in time to smooth things and to capture more profit. But now in this really risk-on period where people were having significant drawdowns, all of the dynamic position sizing due to correlation and volatility management did not help very much. And now with the bounce back, it probably hurts even more. So it is a very interesting. We learn more and more through experience how the difference between the two strategies. But I wanted to comment a little bit on this top 10 list. And when we went to the Turtle program, Rich would tell us, if you follow the rules and lose money, then you'll be fine. But if you break the rules and you make money, then you're going to be in trouble. So all of the people on this list would be in big trouble because they are not following good old-fashioned classic trend rules, and they all made money in a period where they should have lost money. So I'm kind of tongue-in-cheek because I know they're doing lots of other things. They've got to be doing other things, other strategies, shorter term or whatever, to have these sort of positive numbers. But I would just say to the classic trend follower community, don't lose hope. And you're doing fine if you lost money in April and May. You should have lost money, and you'll get rewarded for sticking with your strategy, a very highly robust strategy of waiting for the big outliers.
Yes, and Rich, I'm looking here at the the 5-year CAGR report, and it looks like the top of that list is a manager by the name of Mulvaney Capital Management. Yeah, so I mean, these numbers are phenomenal. It looks like 53% compounded, 53% positive over the last 12 months, and their 5-year returns are 337%, but unfortunately April down around about 41%. So that's taking, the volatility, I guess, to the extreme with the April performance, but still up 53% over the 12-month period. Is that right, Rich?
Yeah, it's the way I understand it too. And when I look at this, I draw the distinction between closed realized balance and open equity balance. And so Mulvaney, we know, swings a baseball bat hard with his unrealized equity. And I think he's prepared to lose that. And so this drawdown, because he's forced to market each month, this drawdown he's experienced in April, it certainly has reduced his unrealized equity, but I don't think it's necessarily compromised his closed balance equity, which is what a classic trend follower typically, that's their line in the sand. And that's when I look at how much unrealized equity we were all carrying coming into April, it was quite large with a lot of the unrealized equity. So the drawdown impact of April certainly has dented our unrealized equity, but it certainly hasn't compromised our closed balance equity. And when I look at closed balance equity over the last 5 years, and for instance with Jerry and with Takahē over longer term timeframes, when I look at the closed balance equity of these, I see it's not compromised. It's continuing to rise despite this volatility, which everyone worries about. This is the risk we're prepared to take by swinging our baseball bets. So, even though Mulvaney was walloped with a significant drawdown, which would have affected investors who'd come in the last few months into Mulvaney at a high watermark, if you're in for the long term with Mulvaney, I don't necessarily think it's compromised his ability to be the powerhouse that he continues to be.
Well, he's still at the top of the 5-year CAGR table at 34% compounded over the 5 years.
That's a recent thing I've been hearing on the non-classic trend following podcast, and that is this new. It's a new way of criticizing classic that I have not heard as much, but it's pretty consistent. That the idea that okay, you've got this classic. Okay, you're protecting capital. And you have your closed trade equity versus the open trade and all this, but you have this major problem with new clients, and they don't have this built up profit, and they're coming in and they could suffer a big 20 to 50% drawdown, and everyone else will be happy, but the new clients are going to be in trouble. What are you going to do about that? So okay, calm down. That's not so bad. If that's the worst that can be said, that's resort to that kind of silliness. But of course, when we've faced that question over the years, we've often said, like, spread it out over time. Now, as Moritz said, now is a good time to buy the drawdown because the open trade equity is low. Be careful buying when the open trade equity is high. However, I've been in situations, fortunately, many times where people have come to me and said, "Hey, you're up 20% for the year, and with all this open profit, should you invest?" And I would be saying, "Be very careful about investing now." And we ended the year up 60%. So I screwed them out of 40%. So you got to be careful predicting performance, and because it can get a lot better or it can get a lot worse.
Yes, well, predicting drawdowns. That's if we could predict them, we wouldn't experience them.
I do like looking at the closed equity curve separately from the total equity curve, and that's exactly what you just said, Richard. It kind of like calms you down. Very rarely, I mean, maybe at the very beginning of your program, you would eat into your closed equity because you're starting with small losses. But a good trend following program, if it runs for a long time, I think you called it the line in the sand. There's no guarantee that you're not going to be eating into your closed equity at some point, but it's kind of like a line that you defend, and that closed equity line is moving higher. And it's kind of nice to look at that separately from the total equity curve.
It's interesting when I look at that closed equity line, I'm thinking to myself, I'm listening to what Jerry said in the past, and Jerry, tell me what you think. If you start compromising that closed equity line, is that where you apply the cutback rule?
Sure. I think you've sort of drawn that line in the sand, and as Moritz said, you've always experienced where your open trade equity exceeds the closed trade equity drawdown. And so when it doesn't exceed it, there has been times where it got close, strictly because we reduced a lot of positions very quickly. The markets dictated in 2008, and maybe now, according to Moritz's program, that he has very few positions on. So this can happen. But you've just got to realize maybe at that point in time when you don't have open trade equity to cover your closed trade equity drawdown, that your capital base, your closed trade equity that you use for your to calculate your position sizes is maybe too large, and you scale it back a bit. one thing that I think that probably happened for the managed futures crowd is, they're sizing these positions daily based upon vol and correlation and asset growth. And this is kind of a dangerous situation sometimes when the markets can go against you. You're putting on these new positions based upon AUM that you have from volatile open trades that are getting ready to lose profit. And so now they're scrambling really quickly to reduce these positions to this new reality of a higher vol and more correlation and less assets under management. And there we sit with properly sized positions based upon our closed trade equity, and not having to be all panic about, hey, let's get these risk reducing trades in the market very quickly, because the one benefit that you always need from your risk management, and I think that I personally get from using this closed trade equity methodology, is you're never put into a position, or you seldom have been put into these positions where you're forced to do non-system trades. You're able to sit back, apply your rules, do the trades you're supposed to do, and not sort of make this across the board reduction or discretionary moves to save your capital. So that in itself is just a huge advantage of always being able to, or historically always, hopefully in the future, compliance is kicking in now, saying, there's nothing more important than actually doing the trades you're supposed to do, and money management can facilitate that or put you in a panic where you're just realizing, I can't keep doing these trades. I have to do something to preserve capital.
Separating these two lines, the total equity line and the closed trade equity line, is also something that I think helps when you speak with clients and you explain the details about your program and your trading a bit more. It helps to understand why most of the volatility that we experience comes from the open trade equity. It comes from trades that have become profitable, trades that have big profits associated with them, that have been on the book for a long period of time or a longer period of time. That is the volatility from winning trades. That is good volatility. It's volatility that we should embrace, maybe harness, but definitely accept as a natural consequence of our trading. And when you then see the closed trade equity curve moving higher stepwise, then that also helps to understand why you should be okay with these open trade profits, or, Jerry, I think you called it being liberal with open trade profits, and I agree with that. It's other people's money. It's been booked to our trading accounts as variation margin from, people or traders that have the opposite position. So we can keep that money at risk because it's not core capital. It's not closed trade equity. And that is, it is the open trade equity that is at risk.
It's the house money. It's not our capital. It's the house money.
Why shouldn't that be at risk when you see the closed trade equity curve slowly moving higher? Maybe it plateaus for a while and it kind of like just moves sideways, but the closed trade equity curve, that's kind of that's what you want. The rest is the noise on top of it that is required to make the closed trade equity curve move higher over time. And so having these trades on and keeping the risk on is important. I know that takes us back to volatility control and all that type of stuff. I'm no fan of having my trades respond to volatility, especially standard deviation of return. So that's the definition of volatility, and or correlation, which is essentially valued risk, where you have the combination of variance of volatility and correlation. Correlations are unstable. They change. I've never been successful forecasting them other than like looking at a very long-term sample. You can equities are correlated to one another. Okay, fine. But whether they'll be correlated with 0.8 or 0.6 or 0.9 in the next 2 weeks is something that nobody can forecast. Certainly we cannot. And then as far as responding or integrating volatility, that calculus into your trading program, volatility is not risk. And I want to give you an example that I think makes clear why why I view it that way. Think about a market such as, I mean, maybe cocoa isn't the best example, but think about a market that starts at like, just say it starts at $1,000 and it's moving higher. It's moving higher and higher. It goes to 1,500, 2,000, 2,500, 3,000, so on and so forth, 10,000. That move doesn't necessarily mean that the volatility will have changed. You know, sometimes markets move higher and they maintain their level of volatility. The standard deviation of daily returns doesn't necessarily change. So you would have that position and do nothing with it. Okay, fine. Now compare this to what we like to use as an average to range, a market such as, for instance, cocoa that moves from 3,000 to 10,000 or 12,000 will now have a larger, very likely, not guaranteed, but it's very likely going to have a larger average true range at that price level compared to what it was. Now, this can then kind of like translate into risk. It is something that we can work with and say like, okay, the notional contract size is now much more. The contract value of one contract is much more. We can kind of like, this is all something that we can incorporate into our risk calculations. Whether we do something with that trade or not is something that is a different discussion to be had. But it just shows why it's so different to volatility. And so the response function to volatility on short trades, on long trades, and because volatility itself is volatile, what usually happens is it tricks you into taking mean reverting and profit taking trades. And that is something that will then take risk away from that open trade equity in all likelihood. Sometimes weirdly, it may actually increase the trading size on a losing position, which is not what you should be doing as a trend following trader that's looking to keep losses small. So it is this dynamic that, and maybe you can say, okay, some of these measurables say, well, it just produces better returns or it has a better Sharpe ratio if that is important to you. To us, the Sharpe ratio of a trend program is actually not that important. What's more important is the raw return that we're generating with it. And that requires us to take some risk and have that open trade risk in place, manage it potentially, but not have it respond in a kind of like micro tinker way to volatility dynamics in the market. And then implementing these trades, if this is your risk in air quotes, control function, is not free of charge. You know, you're most likely paying bid offer, you're paying commissions, all that type of stuff. So I know this is a philosophical type of thing, but to me at least, or to us, this is the right thing of doing it. It also keeps our trade statistics in place.
Things I wanted to mention. One is the reason we don't want to pay too much attention to the Sharpe or any attention to the Sharpe is it doesn't translate, given what we've just been saying about the closed trade equity and preserving that and using that as our ultimately defending that. It doesn't translate into a risk of ruin or a risk of hitting a drawdown. You know, there needs to be another method, and we have methods where we monitor our risk as it relates to the drawdowns in the closed trade equity and how that's offset by the open trade equity profits. But I mean, I'm all for using Sharpe if it fits your strategy of trading. As it does, I think it does fit the strategy of vol management and correlation management. Yeah, you're damn right. They better be using Sharpe. They better be getting out of those positions. They're over trading. We've got too larger positions on based upon the current AUM and the volatility and the correlation. Sometimes they're adding to positions at the exact wrong time across the board. So I think maybe for those guys, for managed futures CTA, Sharpe is fine, but not for us. We have better ways of preserving capital and better ways of looking at risk. And, you know, there has been a lot of talk over the past few years by high-profile managed futures CTAs that now vol is a better indication of the trade being over than trend is. Oh, my gosh. You the trend is inferior. And, of course, I never believed that. And we've shown charts today, and there's lots of charts that show that a prime example of when the vol kicks up, as Moritz was saying, the vol kicks up in cocoa, you could get out of it, but it kept going. And and this happens in all of the market, a lot of the markets. Sometimes vol is a good indication, and I would not be surprised that at every peak in every single trade, the vol is very, very high, or maybe at an all-time high. But it was at an all-time high 5 other times before it got to the peak as well. So you can really leave a lot of money on the table if you use other methods than trend to identify entry and exit positions.
It's impossible to forecast the end of a trend, if I might just say this. I've heard this a couple of times that the increase in volatility or recent volatility or something like that is a precursor and a good estimate for a trend ending, and that is, at least, I don't think that is correct. It's also highly subjective. Like, we all look at charts, and like whether you think a trend might be ending is completely different potentially to what Jerry thinks or what I think, because we view these charts differently. They're only clear objectively once it has ended, once you can see it in the chart that, oh, there's a new 200-day low or something like that. Okay, so yeah, the prior trend has ended. But before that has happened, you cannot say this. And oftentimes an increase in volatility or an increase in the average true range does not mean that the market is turning around. Cocoa is one example. Okay, fine. Maybe I'm just picking that one, but there's so many more where you have this increase in volatility and the thing just keeps going. Maybe it pauses for a while, but it keeps going. It doesn't necessarily mean that it's turning around. So responding to these things is just something that I cannot consistently get a positive expectancy from, put it that way.
And we have our shortest term system that may get out and go short, and the longest term system stays long. So we don't even know when the trends are ending. It ends for system 1, but system 4 is still long. And both of those systems and all the systems in between will have very similar expectations per trade. So we're always hedging our bets and playing the probabilities, but we're never ever making a claim that the trend is beginning or ending.
Yeah. All right, everyone. Well, let's move on to our next segment. Spotlight, where we have a chance to put Moritz under the grill. So each month we shine a light on someone helping shape the future of trend following, and this month it falls on Moritz. So let's start at the top. So what led you to lean more deeply into classic trend? You're not a newcomer to this. You've been in it for many, many years. But what made you lean into classic trend?
Oh, so nothing has changed with respect to how we're trading trends. I think what we're doing with this new fund is we're putting on a different position size, a greater position size. And we do this on purpose. This is by design. Some of our investors have asked us to launch such a fund because they want to make or have a chance of making great returns. What we've experienced and what we've seen over the past, it's really a quarter of a century, 25 years, is that most trend following managers have lowered their volatilities or risk profiles, whatever you want to call it. What used to be kind of like 25 to 30% volatility in the very early days of trend following traders has essentially halved. 8 to 12% is what most CTA funds trade at. And that was just a match made in heaven for the large institutional allocators, the big pension funds, the endowments, the sovereign wealth funds, everybody that kind of like wants to deploy a greater than $100 million ticket. They all want low volatility because there's career risk at play. It's usually somebody that receives a paycheck that's making the allocation. They don't want to look stupid. They want to go with the big brand names, and they want steady Eddie. They don't want any negative surprises, right? So it's kind of like very great for these allocators to have managers that use value at risk control and vol control and all that type of stuff and keep things at between 8 and 12% volatility. But if you trade at 8 to 12% vol, your return expectation is relatively low, at least in our opinion, or it doesn't have the potential to generate big returns, life-changing returns potentially. And most everyone has become that way. I don't want to mention any names, but even the big brand names that we all know, some of the European brand names, some of the US brand names, they used to have higher volatilities 25 years ago, and they no longer have these volatilities. They've responded to these institutional investor demands quite happily. And I can't really critique that, because it's, from a business perspective, it does make perfect sense to lower your volatility, which means you can scale your program and your fund much more efficiently into the billions, because you're trading fewer contracts. And when that happens, the incentive function changes, or the dynamics of the business change to the detriment of the investor, which the investors overlook. And what I mean by that is, what used to be a performance or incentive fee driven business model becomes very much a management fee driven business model when you run many billions, because the management fee income derived from such a large amount of money is so valuable to a business that is what becomes the focus. And the performance fee kind of like pales in comparison to that. And I think that is wrong for our business, for our industry. We're operating in a space where we're actively trading. Whether you call trend following alpha and beta, I don't want to go down that route. I have a very strong opinion that it's not beta. But we're doing something to generate a return that is diversifying, that is different, that is valuable to an investor's portfolio, without exactly knowing what that investor has in their portfolio. It might be equities, might be bonds, might be 60-40, something like that. But we deserve to be paid. And it's a tough enough job to begin with. We deserve to be paid if we're doing a good job in the long run. If we're really producing these, valuable returns, let's call that alpha, then we deserve a performance fee for that. That is the objective of any hedge fund. Using different styles, whether you're event driven or long short equity, it doesn't matter, but it's kind of like the same dynamic. But just sitting on investors' money and charging a management fee, and like with multi-strat pot shops, it's kind of like it's gone to the extreme. I don't think that is necessarily a good fit for a hedge fund. Very different to the ETF business. I know Jerry has ETFs. Like if you're putting stuff into an ETF, say the S&P 500. Now that is beta, and nobody's promising any alpha. Nobody's talking about alpha, because you're tracking the index and you're charging a service fee. That service fee is a management fee, and the market dynamics determine whether the service fee / management fee should be 3 basis points or 14 basis points or whatever, but some kind of like low basis point type of number. So yeah, we don't charge any management fees. We only charge performance fees above a hurdle rate. And we've designed the program so that we can make a good chunk of money over time. Now that also means we'll have drawdowns. Maybe the final sentence on this is also what we've observed is that over the past 25 years, most of there just aren't that many higher volatility trend funds left out there. You've mentioned Mulvaney, I think, Adam. He's obviously one of these belonging to the higher volatility group, and maybe there's 5 others. But that's it. That is really it. It's not a red ocean where everybody's competing against each other. It used to be the standard. It's now become kind of like exotic. It's a blue ocean again, where there's not even a dozen of higher volatility trend following CTAs in that pocket of our industry. So yeah, that's why we did it. But I was very much open to it. I love it. I want to do it. And some of our investors, they said, hey, please come up with something like that. So we happily complied.
Well, it sounds very exciting, Moritz. And then, getting to the nub of the matter, volatility. Are you targeting? Are you forecasting? Where are you going to come in with the new fund?
Who knows where we're going to come in? We're not targeting, we're not forecasting, but the way we do size our positions will probably be between 25 and 35, depending on the month, maybe or 25 and 30. That is what we've seen in the history. But it's, so I expect it to be within that range, but we don't mind it if we have a stretch in our performance record where the volatility is 15%, and we also wouldn't mind it if we have a stretch where it's 35%. It'll ebb and flow. We're not responding to it. We're not looking to kind of like laser point to 25 and make it 25. We need to roll with the punches of the market.
Okay, and is that being distributed over a number of systems? Are you just running one? How are you distributing that risk, and how many markets?
So we trade a number of markets. We do like the diversification that we get by trading a well-diversified portfolio of markets. We trade different systems and different time frames, and I think that is very important. I think in terms of importance or where we can get the most diversification benefits, it really starts with markets. Trading a diverse and independent set of markets is really important. Now, you get to market number 21, 25, 30, whatever it is, and then the additional market that you will add to your program will have a decreasing diversification benefit, but it is still a positive one. So we do like that. So we have this portfolio, and then the next thing is that we're trading different methods, which means we're not just trading one system, we're trading multiple systems in parallel. Now, the diversification benefit we get from that is, again, positive, but not as much as the one that we get from trading different markets. Whether we trade a breakout system or something on a weekly bar or a time series momentum system, things like that, at the end of the day, they will get us into the same trades. They're all long gold. So yes, one system will get that at a slightly different point in time than the other system, but over the longer run, these systems tend to agree. By the way, I should add that we do like systems that are pure in design without a lot of complexities. So we, for instance, stay away from moving averages. As silly as that may sound, it's like a common tool. People like moving averages. They like looking at moving averages, but a moving average is a derivative of price. It is a smooth price dynamic. It is no longer the raw information of the market right now. Whereas if you're trading a breakout, it's the raw price information that triggers the system. Like that is a breakout is a system that is reactive. It reacts to the price action, right? We can trade something like time series momentum where we go like, is the price today higher than the price n days or n weeks ago? Again, there's no averaging. It's very pure price information, but it's different to a breakout system because it's not reacting to a new high right now. It is kind of like programmed to make the observation at certain points in time and react then. So you can already see there that it's getting you into trades at different points in time. And then we combine this with different time frames. So we're trading some very long-term time frames. We're trading long-term time frames and some medium, maybe still long-term time frames. We're not trading short-term time frames. We don't have any edge in the short-term space. I don't think we will be focusing our research on the short-term space anytime soon. It's just not what we do. We're not set up to do this operationally. What's long-term, medium-term, and short-term, by the way, is also subjective. There's no kind of like clear rule or law out there that says this is short-term and this is long-term. So I can give you my subjective definitions of that, like in a kind of like breakout, in a breakout type of space. I would say everything that is higher than a 200-day breakout is probably a long-term system. And then you can say, well, maybe it's 300, 400 days is then super long-term. Between 100 and 200 days, I would say that's medium-term. And if you're, less than 100 days, I would already call this short-term. For some people, 100 days is still medium-term. It's just, that is my subjective definition. So we're not less than 100 days. We do like these longer-term trends. They come with a bit more drawdown, but with greater profit potential.
And what's the name of the program, Moritz, and when does it start, or has it started already?
It has started this month. I must say, we were just very lucky to have missed April. This is really only because we didn't have the brokerage account open in time. So yeah, we delayed it by a month. We started on the 1st of May, started putting some positions on, and we're actually up a little bit this month with the Pure Trend program. And
that's what it's called, Pure Trend program?
No. It's called the Global Markets Fund. That's it. But what that fund trades is our existing live systematic trend program, which is live since the end of 2017. It's trading it in the exact same way, but it's putting on more risk per trade. That is the change, essentially. Right. So it will have greater profits. It will have bigger losses and drawdowns. Over long run, it should have a higher KGAR.
Jerry, anything you want to ask Moritz about his new program?
No, I think it's a really good idea. I think it is. I like that idea quite a bit, and I encourage people to go down that route. I think I do. I do think it would be good to have a podcast and talk about both of those big issues, which is leverage and volatility and expected annual profits, and then fees. There's a lot of I think that I understand where he's coming from and where people come from who charge only incentive fees or large incentive fees. But it's pros and cons, I think, to both ways of doing it. And Covell got onto this idea recently that you can't even be a real trend follower if you don't trade really large. Like it's a betrayal of our forefathers if you don't trade like Richard Dennis and the Turtles. And so I've always left that one part of your trading size and how much you can handle volatility and losses. That's the one thing I would leave open to 100% discretion. In order to trade and follow your system, you need to choose difficult systems and choose systems that are hard to do and follow the rules regardless of how painful it is. But you can, I will give you some leeway as relates to the risk that you want to take on. Some people don't want to take on large risks. They're perfectly good trend followers, and some people do want to take on larger risks. But I think these are both really good topics that do their own podcast to talk about them, and because I think there's pros and cons to all these different ideas.
Yeah, we should do a podcast about it. I gave that a lot of thought as well. I don't want to kind of like diss people or funds that charge management fees. Some of them do it for a good reason. We've just made the decision that it's not a good fit for us, but it depends on the liquidity of your program, etc. But the argument that I sometimes hear from like large allocators is, oh well, I want you to charge a management fee because I want you to stay in business if and when the going gets tough and you're in a drawdown. Because we're putting that much time and energy and resources into due diligencing you for a year, and it kind of like needs to be worth our time, and then we want to be investing with you for 5 years. Well, they will quit their investment anyways when the going gets tough. Usually, the 5 years expected time frame becomes 5 months when you're in a drawdown. And in our line of business where we're trading futures contracts, which are liquid, look, there's the exit door. It opens every month. If you're not happy about it, you're free to leave. What's the big deal? Hopefully your account will be at a higher value at that point in time. I just like if you're a private equity fund or something like that, maybe that is maybe their management fee makes more sense. But for me, I just decided that our entire business should be free of management fees and only be focused on performance fees. And if we have like a tough 1 or 2 years, then people need to rely on us not having super high costs, which we don't. We're not just spending money like crazy. We have some resources, and we'll just keep going. I think that's very fair.
Moritz, how are allocators reacting when you explain your program to them?
So what's very nice with that is, by the way, we've had a good start in terms of raising money and people being interested in our new fund. At that level of volatility that we trade, we don't have a single institutional investor, and we can completely free ourselves from that client category, which I find is very liberating. Because talking to look, I'm kind of like grew up in that space. It's talking to these allocators and investors is a waste of their time, is a waste of my time. They're not going to be investing in our fund, period. So let's just move on. It's just not a fit. 30% volatility does not fit with them. End of discussion. So we don't have to speak with them. The people that we speak with are high net worth individuals, accredited investors, people that can invest in hedge funds, but they're usually private investors, individuals, or family offices. These are the two client types that we'll have conversations with. And we speak with every single one. Nobody is allowed to make an investment in the fund if they don't have a chat 30 minutes with the two Moritzes. That's just 30 minutes, but it's there for us to get to know our investors and explain to them what it is that we do and how we trade, and that they need to expect double-digit down month, but hopefully also expect some double-digit up month. That it can be psychologically and emotionally difficult to hold on to that thing, because you get punched in the nose occasionally, and hopefully you'll make it then back. And we just want them to, comfortable is the wrong word, we want them to understand it and be okay with the risk. Because if they're not, and they're giving up on the investment in like the second or third month, it's usually because we're down, and then it's not good for them. It's also not good for us. Nobody's happy. So we just want to make sure that it's a fit for how they think about trading, for how they think about their portfolio, and so on. And we need to like them as well. Give them opportunity to ask questions. And well, we haven't turned down anyone, but it isn't like if somebody came in as like, I really want you, with a completely wrong expectation about that thing, then you shouldn't be giving us your money, right? It's not a good fit. Buy something else.
All right. Well, thanks very much for that, Moritz. So let's move on to turtle tidbits. Adam, time for you to take over.
Welcome to Turtle Tidbits, where we take a step back, dig into a key idea, philosophy, social media gossip, or a reflection of what's been on our minds this month. Each episode, we explore a topic that sharpens our thinking around trend following, whether it's about design, execution, mindset, or managing through uncertainty. And today's topic comes from Jerry. So over to you.
This is a good topic, and I'm expecting lots of good comments from everyone else. But this is a discussion I had on Twitter, and it revolved around this old cliche that I really dislike, which is if you lose 50%, you need to make 100% return to get back to even. So, I mean, that's an accounting thing. Rich and I majored in accounting. So, we're accountants. That's an accounting thing. And of course, that's what the performance table says. But for traders, and one thing that bothered me about this is there's never a follow-up. Like, okay, what's next? And the follow-up is, there's been a dozen times the S&P has been down 50% and it comes right back. So I think you're trying to give me the impression that, oh my God, if you're down 50%, the world is now falling apart. You have no hope for the future. To make 100% sounds just unbelievably difficult. And yet it happens all the time. We see it in traders and the S&P and these stupid indexes. So In fact, it does happen a lot. And it gives off this impression that how critical it is to avoid having drawdowns. And my point was to show evidence of traders and indexes that have, in fact, had frequent 50% drawdowns, and been very successful in some of the best performing of all time. And it's almost as if part of being successful and having a good process and a good system requires you to have these drawdowns of 40 and 50%. It's not something that's going to stand in your way, but it's almost like this is not a bug, but a feature. Yeah, like that cliche as well. And so I think we've kind of talked about this already, and Moritz obviously is going to has created a new program that is going to welcome this type of volatility and drawdowns because it pretends better returns, higher returns. And this was the point I was trying to make, that you're not destroying your compounding because you're having larger drawdowns. In fact, it looks like it's a requirement in order to make 20% a year like Buffett, is to have multiple. I asked ChatGPT how many big drawdowns that Buffett had, and he had 4 that were over 45%, and he compounded at 19.8, twice as much as the S&P in his history.
Yeah, it's interesting. I think I saw something like, well, even more extreme with Bitcoin, maybe down 90% a couple of times or 80%. And then obviously it's recovered to almost an equity all-time high. So, Moritz, what are your thoughts, given the high vol product or higher volatility product that you're launching? What's your view?
In terms of making the drawdown back, my expectation is that we will have, as Jerry was saying, deeper drawdowns. We're already steeling ourselves for this today because we know it's going to happen. We don't know how deep that drawdown is de facto then going to be, but we will have one. And but like I said at the very beginning, the risk releasing function, as Rich put it so nicely, is so great with our way of trading and the way that we've designed our systems in a resilient fashion. It should really avoid the blow up. Obviously, the worst possible drawdown is 100%, right? But hopefully, with our way of trading, we don't get there. If we're consistently applying our rules, following these rules, and trading the model, then we should get out of these drawdowns. And sometimes the recovery from these drawdowns can be surprisingly fast, and sometimes it's not. But I guess, Jerry, with all the experience that he has, Jerry, you've probably had drawdowns where you thought, oh, that's probably going to take me a year to work out of. And then 2 months later, you're kind of like, oh, that was it. Or a couple of days later, that was it. You're back. But this only happens. Yeah, this only happens when you keep the consistency with your way of trading. If you're freaking out, vol controlling everything down at that drawdown, then that decreases your chances of making it back or making it back fast. So it is these inconvenient things in trend following trading where, you're not happy. Maybe you're grumpy because you're in that drawdown. You have these losses, but the good trend following trader, if I may say this, will put this to the side and just put on the next trades, exactly as dictated by the system. As difficult that is, you might say that this is actually what our investors are paying us to do for them.
Exactly. I agree 100%. It's exactly what they're paying for. And then towards the end of this debate on Twitter, the whole tone changed to where, okay, the original statement is, okay, it's a little shaky. Now, since you've kicked my ass on this debate, now let's focus on it's clients who are forcing you to do this. Clients won't hold on to your trading. They'll get out. Okay. So we can't control what clients are going to do. You're going to have a great track record, Moritz. I'm sure you're going to have clients that are going to bail at the wrong time. Congratulations to you for doing this and for sticking to your system and not letting the client's weaknesses and their inability to do the right things contaminate your trading. And this is another thing we're paid to do, is to be better than the client who is emotional and wish they could be a trader, and they're not a trader. So that's why they hired you to do it, be a trader, because they have all these normal human failings that we had at one point until we got over them and saw the power of systematic trading.
Look, in relation to this discussion, I don't think many people understand what outlier hunting is, because when they're talking about the impact of drawdowns on geometric returns, in other words, compound annual growth rate, they're only looking at the downside impact of compounding. Now, we do know that the impact of a drawdown is more severe than the impact of an upside return, by virtue of the penalisation that occurs with compounding with drawdowns. There's this drag associated with drawdowns. However, people forget that it is a necessary accompaniment if you want to attack these outliers, which are many orders of magnitude above, or they create lifting power many orders of magnitude above the penalty associated with the drawdown impact on compound annual growth rate. So if you could imagine the standard return path, or the path of returns that a classic trend follower will have, is they might enter periods of drawdown, but they'll have these significant uplifts in their equity curve, which compensates for the drag associated with that compounding drag of the drawdown. Now, this total effect of both the uplift, which everyone forgets about because they're not outlier hunters, they're only concerned about drawdowns because they don't have anything to lift up their portfolio. I can understand why they're focused on drawdowns and why they need to smooth returns when they've got nothing to compensate against that drag. But outlier hunters, we are a specific class of trend follower who predate on these significant multiple R events, these uplifts, and that more than compensates for that compounding drag. So when pound for pound, you look at the path-dependent returns of a trend follower who volatility targets or dynamically position sizes, sacrifices their uplifting power, the impact of drawdowns is severe on their compounded wealth over the long term. But for an outlier hunter, we overcompensate with our outliers, and that what gives us what we've seen it earlier in our discussion today when we compared the classic trend index against all of the other indexes. That lifting power is by virtue of the uplifts that are overcompensating for the drag associated with our volatility. So pound for pound, when you compare the returns of the TTU trend following index, SG trend index, they're all clustered together because they're not emphasizing outliers. That is what distinguishes classic trend from the rest of the bunch, because we are harvesting opportunities with these uplifts, which gives us this compounded wealth. So look, we're running out of time now. We'll push a Shell Mail listener, which was from Slav Z, to next month. So we'll be responding to his question in next month's podcast. Thanks, Slav, for putting in your question. We'll deal with it next month. But gentlemen, many thanks for attending today's Turtle Talk podcast. It was a pleasure. Next month is going to be a beauty. We've got a special guest lined up. Jerry, you put us onto that one, so many thanks, Jerry. And Moritz, lovely to have you here this episode. I hope you're not going to be a stranger to this Turtle Talk podcast. We want to get you on more and more, and perhaps get into these discussions we talked about performance fees and all of these things. It'd be great to have you on again shortly.
And of course, congratulations on the launch of the new fund, and we wish you all the best.
Thank you. I appreciate that, everyone. Thank you for inviting me and the good wishes. And I'm very happy to do a separate show at some point on fees and management fees and performance fees and stuff like that. I think we can put this into a separate box and kind of like separate this from technical trend following trading discussions.
And Jerry, many thanks for your wisdom once again this episode. Thanks for being here.
It's a pleasure. Thanks for having me.
If you've enjoyed today's show, spread the word, subscribe on our favourite platform, and don't forget to send in your questions for Shell Mail. So until next time, everybody, stay systematic, stay patient, and may the trend be with you all.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.